A stock's price to earnings ratio, or PE ratio, is one of several measures that investors can use to figure out whether a stock represents a good value. To calculate the PE ratio, divide a company's current stock price by its earnings per share, or EPS, over the past year. This gives you the stock's trailing PE ratio. You can also divide the stock price by analyst estimates for the coming year's EPS to get what is called the forward PE ratio. The PE ratio demonstrates how much an investor is willing to pay for a single slice of a company's earnings. For example, if a stock with earnings per share of $2 is trading at 30, its PE is 15. An investor pays $15 for each dollar of earnings. Investors use the PE ratio to help determine whether a stock is a good value. Generally speaking, the lower the PE ratio, the cheaper a stock is, and the higher the PE ratio, the more expensive it is. But it all really depends on how that's valued against other stocks in similar industries and against the overall market. A stock with a low PE is often called cheap, and that typically indicates market pessimism about that stock. If investors think that pessimism is misplaced or excessive, they might figure it's actually a good deal. Conversely, a stock with a high PE is often called expensive. Investors might think a high PE is too optimistic, and that it might be time to sell before perception meets reality and the price drops. Broad market indexes also have their own PE ratios. For example, over the last 5 years, the S&P 500 has had an average PE ratio of about 19. Meanwhile, the Nasdaq Composite, home to many high-growth tech stocks, has had a higher PE ratio of around 26. The PE ratio isn't the only financial metric that investors can use to determine value. Other calculations compare a company's stock price with its revenues, the price-to-sales ratio, or with the value of its assets minus its liabilities, the price-to-book value. More complicated calculations exist as well, but the reason to look at them is the same: figuring out whether a stock represents a good enough value to hold it in a portfolio. PE ratios and other valuation metrics can be useful tools, but using them is not an exact science, and it involves a ton of interpretation. It's important to consider a stock's PE ratio in the context of its industry peers and its growth rate. Generally speaking, faster-growing stocks tend to earn higher PEs. That can make them risky, because their stock prices can crash back down to earth if they fail to deliver on investors' expectations. Slower-growing stocks with lower PEs don't have to hit as high a bar, so they may produce steadier returns. There's no guarantee of that, though. Sometimes a low PE just means a company doesn't have a very good business. If researching stock valuation sounds like more work than you want to do, you can invest through a mutual fund or exchange-traded fund and leave the heavy lifting to the pros.